This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Thank you for joining us today on Money Talk. Here's a rundown of today's show. We start with Tom Peckloff of the Ottawa Business Journal, then to Matt Henrik, Senior Vice President National Sales at Sprott Asset Management, and on to my interview with John Embry of Sprott Asset Management. In the second half of the show, a two-part interview with David Prince, who's the founder of Harbinger Capital Markets Research. We conclude today's show with Francis Cordolino, who's a principal at CMHC, talking about the Montreal real estate market, and then close with Christina Partsenevelos' interview about Harley-Davidson's first ever cafe in Toronto. But first to Tom Peckloff of the Ottawa Business Journal. It's good to be joined by Tom Peckloff of the Ottawa Business Journal. How are you, Tom?
I'm doing well, John. How are you?
Okay, I hope you're enjoying this weekend. And now we've got to get on to the business of Ottawa. During the past week, Tom, we had some major funding announcements this week and a celebration of some of the business community's rising stars.
Yeah, that's right, John. Let's start with the big funding announcement from Thursday. It was Graphite Software announcing it had closed an oversubscribed round of Series B financing worth $8 million, led by Beijing venture capitalists, ZVCA, and includes participation from Toronto's Green Century Investment and also Ottawa's Celtic House Venture Partners, who were the Series A lead investor in the company. According to Graphite CEO Alec Main, the closing of the round demonstrates investor confidence in the company's ability to execute and the market opportunity in front of it, and it will allow Graphite to expand their team and accelerate their product growth, both in Ottawa and in Beijing. The company plans to add 20 people by the end of the year. The ZVCA President Jason Wang has said that his group sees real value in Graphite's solution. It's called Secure Spaces, and what it is, it's an Android virtualization platform that allows multiple virtual devices or spaces to coexist on a single device. So that way, your personal space or maybe your kid's space, your workspace, your secure banking spaces never mix. So their solution addresses both security and privacy issues. And it was deployed last month on more than 150 million devices in China.
And another big announcement happened the day before.
Yeah, that's right. About 350 people gathered at the La Roche Park in Mechanicsville on Wednesday. It's right across the street from the Innovation Center at Bayview Yards, which, of course, is set to open this fall. Now, those people were political leaders, industry, academic leaders, and they were there to hear a whole lot of politicians talk, but most importantly, the Minister of Innovation, Science, and Economic Development, Navdeep Bains. And he announced the federal government will invest up to $8 million in the Innovation Center. This on top of the $30 million already coming from the province and the city. According to Mr. Bains, we must scale up, and the goal is to give SMEs the support they need to bring their goods and services to market a lot faster. He said that the center is expected to help about 1,200 businesses accelerate the development and commercialization of more than 200 products, and it will create more than 280 jobs in the community. Now, we now know that the Advanced Digital Media Lab and Makerspace will be run by Prototype D with some other collaborators. It will be called Made Mill. It'll be meant to speed up technology commercialization by providing entrepreneurs with everything they need to design and develop their test products. There will also be a cybersecurity program, the Global Cybersecurity Resource Program. It'll be run by Carleton University's Technology Innovation Management Program and Venus Cybersecurity, both projects of Carleton's Tony Belletti. They will provide entrepreneurs with cybersecurity experience, and it will also develop commercial cybersecurity solutions. So this federal money will go to support those programs. It will also strengthen the digital media, software, defense, aerospace, and security, and clean technology sectors. All four of them considered to be high-growth industries in the local economy.
And the Ottawa Business Journal and the Chamber of Commerce held one of its biggest events of the year this week.
Yeah, they certainly did. The 40 Under 40 was Thursday night at Casino Lac Leamy. You had some CEOs, some painters, some brewers, writers, health professionals who are all named to the top 40. More than 200 nominees originally, so it was quite a process to whittle it down. Carrie Asaf, a 34-year-old co-owner of Cardiff Health Food Centers, is one of the recipients, and he said it was a very nice feeling to be recognized, and you get to realize how similar you are when you see the other 39 people in the same room. Another recipient was Catherine Clark, and her father, Joe, spoke at the event. He was rather famous for being successful under the age of 40. He, of course, officially became Prime Minister a day before his 40th birthday. And he had some sage advice for the crowd, including things we thought we knew no longer apply. You can reach a much wider world, but it won't be the world or we know now.
And what's on the OBJ radar for this week, Tom?
Well, we have a couple events that we'll be covering and attending for sure, including the L-Spark SaaS Showcase, which goes Wednesday night.
Thank you for joining us, and enjoy the rest of the day, and we'll talk same time next week, 2 p.m. on Sunday.
Sounds good. Thanks, John.
Take care. And now to my chat with Matt Henricks of Sprott Asset Management. Well, I'm with Matt Henricks, who is Senior Vice President, National Sales at Sprott Asset Management. How are you today, Matt?
I'm great, John. How are you?
Okay, it's a hot one, and we have come off a week in which the markets seem to have been treading water, waiting for news, particularly on the Brexit vote, which will take place coming Thursday. Now, I was wanting to get your review of some of the Sprott funds' representative performance to give us an idea of how markets performed during the past week, and you can reference back to the first of the year.
Sure, John. Of course, I think we all know that the precious metals and energy have just been flying off the shelf this year. Even after a month ago, we had a pullback in the bullion and the gold stock. They've come screaming back. Our gold and precious metals fund is up over 80% on the year. Our silver equities class, so we are the only fund company in Canada that has a dedicated strategy to silver equities, is up 95% year to date. And the energy is just around 40. So our resource guys are really adding value to the overall portfolio. As you say, the generalists out there, they're treading water. I mean, the markets are just a couple of percentage in the plus point so far this year. And Brexit next week is a huge vote. And we got the U.S. election coming up and then decisions on interest rates. So there's a lot of nervous investors out there. And so core strategies have not really been moving. But, you want to have your dividend payers, and you definitely have your sleeve of precious metals and energy.
Now, yesterday I attended the Vintage Wings event at the Gatineau Aerodrome, and it's an absolutely fantastic museum, and it was an incredible event because Chris Hadfield was there, and of course Sprott Asset Management were one of the supporters of the event.
Yes, actually, we were the main supporter, and I got involved through the McGann team at Scotia Wealth. They're good Sprott clients. And I got the opportunity to be a sponsor of Chris Hadfield. I mean, Chris is obviously Canada's most decorated astronaut, and yet now he's on the speaking tour. He's well sought after. And we were very happy to have him last night, Saturday night, hosting a private dinner event. And then he's going to be doing a youth run today, Father's Day. And then at the end of the month, he's hosting a huge summit for kids, a youth summit. And that's going to be hopefully a big success, too. So we're really happy to be tied to Chris Hadfield.
And I believe that event will be at the Gatineau Aerodrome on the 30th of June. Is that correct?
Yes, right at the end of the month. And it's going to be a great day for kids, and that's one of Chris Hadfield's passion is giving back to the kids.
Well, today I'm going to play an interview which I recorded with our old friend John Embry, who's the chief strategist at Sprott Asset Management and a really experienced investor, and it's a must-listen, and that will play after the break. Oh, before we go, could you give us your coordinates for listeners and advisors?
Absolutely, John. I'm always reachable at toll-free at 866-299-9906, and always remember to visit sprott.com.
And I understand that you're off for a week of holiday, and I hope you have a good time. But we will talk again next Sunday.
You bet, John. And happy Father's Day for all the fathers out there and yourself, John. And we'll talk next week.
Well, likewise to you, and you've got some heavy lifting with your two guys.
You bet.
Take care.
Okay, John. Bye.
Okay, folks, we're going to a break. And after the break, my interview with John Embry, who is senior strategist at Sprott Asset Management and a really clever investor. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
It's great to be joined by John Embry, who is a senior strategic advisor at Sprott Inc. How are you, John?
Excellent, actually. I'm very bullish on the picture in gold. We can discuss sort of the short-term intricacies as to what's going on right now.
Well, yesterday we had a new high for this move, over $1,300 U.S. an ounce, and then a reversal, and that probably gave a few chartists nightmares. But I'd like to start with your macro look at the world that is a reason for one to have a little bit of gold and gold shares in one's side pocket.
The world is in sort of the early stages of a tough recession or worse. And very simply, it relates to the fact that there's infinitely too much debt in the world. And if you believe in Austrian economics to the extent I do, when you reach this stage of too much debt, you can't add debt productively, so the economy just wallows. And what's happening is they shove more debt into the system. They can't support it without interest rates dropping to almost zero, and that sort of sparked this whole move to negative interest rates in Europe and sort of very low interest rates in many other parts of the world. And it's just going to continue in this direction until we either have hyperinflation or a collapse. So I think anybody who thinks this is sustainable is going to be proven wrong.
We've had some major European banks hitting new lows, Deutsche Bank, Credit Suisse, and these are not little banks. And that's a bit of a signal that the banking system is sort of at the end of its tether.
Well, the banking system in Europe is a potential tragedy. Aside from the enormous leverage and derivatives, they also own enormous quantities of sovereign bonds in countries that are essentially, for all intents and purposes, bankrupt. Greece, Portugal, Italy, et cetera, There's no way out of this without sort of recapitalizing them, and that's coming in the future.
You and I have been on this gold story for a few years, I guess almost 50 years, and we went through the 1970s. I guess I'd ask you how you would compare the health of the global economy and the U.S. government today to where it was in the 1970s.
Well, there's absolutely no comparison. I mean, you've added so much debt in the interim. Like, that you could measure the debt. People talked about debt in the billions in those days. Now we talk about them in the multi-trillions. So consequently, there's no room for sort of what Paul Volcker did in 1980 when he sort of quashed the inflationary sentiment and sort of set up a long-term financial asset inflation, which has brought us to today. So I would dare say that gold at the bottom of this cycle, which was in 2000, at 270, 260, was infinitely cheaper than it was when it was $35 at the beginning of the 70s. So I would expect to see a move before it's finally over that will dwarf the move from $35 to $850.
Now, we have various wild card or potential wild card situations, one of them obviously being Brexit. Who knows about the Middle East? And we've got the American election. And I just came back from China, and you and I were just chatting about it. And I figured out that the Shanghai Gold Exchange is not really an exchange. It's a collector of gold from around the world. And that China will announce its official gold holdings when it's good and ready. And I would guess that those will be pretty significant numbers. And the Chinese government is allowing people in China to buy gold bullion through the banks, and that's a very interesting phenomena. We know that there's an awful lot of paper that ostensibly represents gold, and then there is only so much physical gold. When do we hit the wall on this one?
I think we're getting very close, John, quite frankly. Some of the numbers I look at, with the number of paper claims on each available ounce in the West, are like staggering. I've seen numbers as high as 350 to 1. But even if you used 100 to 1, it doesn't make any difference. The number is absurd. So one thing I would strongly suggest to your listeners is that if they own a paper gold instrument, they had best be sure that it is backed fully with the gold it is allegedly backed with, and I would say 98% of them aren't. So this is going to come to a head, and at the very time people need their gold, if they have the wrong gold vehicle, they're going to get settled in paper, and the last thing you want at that moment is paper, and that's what you're going to get. So you got to have the real thing, not to tout our own firm, but the Sprott Physical Gold Trust is real. It's backed by every single ounce that it purports to be. There are several other vehicles around the world in that fashion, but not many. And the other alternative is to have gold bullion in your own possession, but you must have it out of the banking system.
Now, I think of the Royal Canadian Mint's exchange-traded receipt and the Sprott Physical Gold Trust, which is listed on the Toronto Stock Exchange as being suitable vehicles. And in the case of the Sprott Physical Gold Trust, all of the gold is held in storage by the Royal Canadian Mint.
Yeah, and it is audited regularly, and I can assure the listeners that it's all there.
I have actually been bunking in on that audit because one of the people I advise has gold sitting right beside the Sprott gold in the Mint, and I've been with Ernst & Young on that audit.
Well, I'm glad to hear third-person confirmation of what I just said.
And then, of course, there are gold shares, and we both had a pretty good experience in the 1970s in gold shares. They're really a future call on gold in the ground. Could you give us some advice on that?
When gold shares bottomed on January the 19th, 5 months ago this coming Sunday, they were the cheapest I have ever seen them in relation to the gold price, which was also depressed at the time. And since then, in the space of 5 months, they've rallied 130% on index, which is remarkable in itself. And yet they remain very cheap, and the fact is their leverage to gold is remarkable. And if the gold price does what I expect it's going to do, which is move up dramatically from the current levels, I think that the gold shares will be one of the great profit-making opportunities in my lifetime from this point right now.
We're in this environment of competitive valuations around the world, and I guess the next major shoe to drop in that department is that the Chinese renminbi will be devalued to make them competitive yet again in trade. And in a devaluation era, you have to have something that will hold its value, and gold has historically done that. What sort of percentage should somebody consider having? That's depending upon their investment objectives, but we're not talking about people putting all of their money in gold vehicles. This is really a bit of insurance against all these variables.
Absolutely. I would suggest that at this moment, an absolute minimum is 10%. And it could be sort of partially in bullion and partially in shares. And if you're more aggressive, if you really agree with what I'm saying, you could be higher than that with probably more emphasis on shares in the short term, because I think they've got the real leverage. But the long-term holding, the one you probably won't sell, is the bullion. The shares are a trading vehicle with enormous upside.
Okay, let's get to silver, John. How are you feeling about silver?
Well, silver to me is just waiting for this explosion in the sector. And at that point, as history is any guide, and I believe in this case it's going to be a great guide, the gold-silver ratio collapses. And right now it's about 74 to 1. In true bull markets, that can fall as low as 15 to 20 to 1. So as much as I love gold, I think the upside in silver is multiples of what it is in gold. So, I mean, say gold went to $2,500, I could see silver easily going to $100 or from these levels. So I think basically they call it poor man's gold, and I would strongly recommend that individuals get into silver stocks and silver coins and any sort of silver vehicle, because I think the amount of money that's going to be made here is going to be mind-boggling.
Now, among the Sprott strategies, which are the funds that investors should take a look at with the help of their advisors in silver, gold, shares, and then, of course, we have mentioned the physical?
Well, our two physical trusts, the gold trust and the silver trust, that's the bullion. I strongly recommend people take advantage of that. Our precious metals fund is very well managed by our young team, and I don't think you can go wrong buying it at current prices.
We have seen tremendous manipulation of the gold market because it's sort of the anti-dollar vehicle, and the powers that be are trying to keep the currency order together as long as they can. This is Friday morning, and yesterday, Thursday, we saw tremendous volatility in gold, and I guess the advice for people is don't watch this stuff day to day, and it will do its job through this very difficult and challenging period that we're going into.
I totally agree. I mean, I think the easiest way to do it is dollar average, because this thing is volatile because there's so much interference in the market. I mean, yesterday, there's not a market on earth that would have done what gold did yesterday. It had broken out cleanly through 1,300, hit 1,315, and then out of the blue, a massive wave of paper selling hit it and drove it down $35 in the space of no time. No market on earth acts like that unless it's heavily manipulated. And not surprisingly, when the open interest number came out today on the COMEX, open interest had grown 20,000 contracts, or 2 million ounces of notional gold. When you throw that much gold in a market in a very short period of time, not surprisingly, it goes down. That's the modus operandi. It will be overcome in time, and when it is, the gold price is going to the moon.
Well, it's interesting that George Soros has come out of retirement, in effect, at the age of 85 and taken a decent position in the gold market. You've got people like his former partner, Stanley Druckenmiller, and then at Sprott, Eric Sprott, who has a really significant gold position. And these guys are experienced. They're not lightweights. And to me, it's a signal that the game is on.
Well, there's no question. And another guy you didn't mention is who was probably the most successful hedge fund operator in the States, Ray Dalio. I mean, he's been very outspoken on the attraction of gold. So I think a lot of people with long-term positive track records are speaking out on the subject now. And they know what they're talking about. The vast majority of people are getting misinformation on the subject. They don't have any exposure, and they are going to be badly hurt in the fullness of time if they don't have exposure. So any of your listeners that are listening to this, don't try to time it. Basically, start buying some and just average in going forward.
Yeah, and I guess I'll reiterate that people who are listening should talk to their advisors and just go over their objectives, and that they take a position that will give them some insurance but allow them to sleep at night. John, as always, it's a great pleasure. This has been an eclectic chat. We'll talk again soon.
I think it's a very important chat, John, and I would emphasize that to your listeners.
Thank you. Okay, folks, coming up after the news, a two-part interview with our affiliate BNN and David Prince, who is the founder of Harbinger Capital Markets Research. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
The British pound has been taking a beating in the weeks leading up to the June 23rd referendum on EU membership. Well, for more on this and what we can expect, less than a week away now, we turn to Harbinger's David Prince. David, so good to see you.
Well, nice to be here.
All right, so obviously the first casualty of all this has been the pound sterling.
Well, this is the best barometer that we have in terms of the currencies are always a great way to look at a particular crisis or to see the extent to which people have hedged themselves, and the obvious one is, of course, the currency. There's no magic here. People have been doing so for, as you can see, the longer-term chart, you will definitely see that they really decided that once that poll changed dramatically, just a little over a month ago, you could see that the pound really started to get weak. And the more important thing that I've done here is to give you an idea of the weakness to the yen. So that basically says that falling yellow line, in particular the last month, you'll see is fewer yen to get a pound. So that means yen strength, pound weakness. And it's been very clear in that particular case. So the bigger speculative money has made a lot of bets already. And so I guess the conclusion you come up with is none of us know where it's going to turn. We've had a lot of things that have happened this week, and clearly that tragedy that happened yesterday is one of them. That said, What I'm finding out now is a little bit more to what we're hearing internal of Britain as opposed to all the external, which is really the hype and hope. That reminds me a bit of what happened here in Canada when we had the referendum that got so close, and then people realized, oh my goodness. So we're going through a little oh my goodness moment right now in UK.
I wanted to talk a little bit about yields on the decline, because that's been another symptom of this. People rushing into the perceived safety of government debt, even though it doesn't pay anything. Perhaps negative in some countries.
Yes, well,
but yet the rush is on, and we've seen.
Yeah.
I thought one headline was great. Basically, the yields have been pushed to the lowest they've ever been since human beings started lending each other money.
Well, okay. I haven't got dates that far.
I don't know if I can go
I've got a little market history, but not that long.
3000 BC.
Yeah. Well, that said, there's no doubt that this whole environment has been created by central banks and politicians who are scared about the alternative of no growth and inflation and everything else. Well, the result, of course, has prompted even worse fallout. And what I mean by that is we've got this desire to get a return, but we've got no place to go. So what people are doing in global basis is taking on more risk without really assessing it properly, because it's a matter of I don't want to be in negative instruments. So the craziness of this whole doctrine has not been fully played out. And it's certainly one that I am more fearful about than I think the market is at this point recognizing. There is no doubt that what we've got are a bunch of places that have needed returns, but they've been seeing it. In Canada, we've seen it more recently, the chase into real estate. We saw the chase into commercial real estate this week. Well, all of this absurdity has to get a return at some point. And when you do that, when you got the governments that are now buying corporate bonds, as we know in Europe, it makes for a very distorted view of the world, and certainly from my standpoint, to see yields that we've seen here, and I don't know if we got the picture up yet, but what makes it interesting to me is the UK yield on 10-year has definitely not dropped to the levels of the European. So we've seen the one in the bottom, which is Germany. It went negative briefly this week. We're back to just slightly above the zero line. But that said, here's what you've seen with the UK, is that it started to come down. And what I find interesting is if you get the leave verdict, where does that put the UK rates? And that's where there's some vulnerability. So be careful about what's going on with the UK bonds, particularly the 10-year bonds.
Wanted to take a look at something you call Big and Little Britain as well, the small caps, how they've been performing or outperforming.
Well, this is it. I mean, surprisingly, small cap UK companies have been outperforming the basic index. The confusion about the British big market is that it's so weighted with big international pharma and big international weighted banks, big international oils, and I'll emphasize that as well. The oils have been a major reason for the bigger caps having this decline, and certainly have followed the rest of Europe in the underperformance in 2016. What it basically says is the health of the UK small caps is pretty good. But it also means that there's a lot of confusion because some of those small caps have been able to get entries into that bigger market because of the involvement. So there's some vulnerability here in terms of the small caps, and if you're playing those in the UK, that's an area of vulnerability.
Okay, we're going to be back with David Prince. We're going to talk about Brexit still. It's hammering the bank stocks in the UK, as many would expect. Stay tuned. We'll have a lot more to say. European banking sector bracing for another hit to profits if the UK votes to leave the European Union. Fears of short-term market turmoil and the possibility of one-time restructuring costs tied to the relocation of their banking operations, that's hitting their share valuations. Well, for more on this, David Prince of Harbinger rejoins us now. David.
Well, I think that the pictures certainly tell the 1,000 words that's necessary for this. I've brought in the charts of the FTSE banks and the FTSE Lifeco, so it gets a pretty good section. And they are the most vulnerable. At least that's what all the pundits tell us. I certainly find it hard. But I want to go into it a little bit more, because what you're seeing with that FTSE bank that has the picture in white and the fact that they're nearing lows is not dissimilar from what you see when you look at any of the European bank indices. They're all in trouble. But the dominant feature about the FTSE bank, and this is something I say to all people when they're looking at indices, I spent a lot of time looking at indices when I was at the TSX, but the big point is that be careful about the weightings. So in this particular case, the most vulnerable stock that people have been looking at is HSBC. Well, the HSBC woes are not necessarily Britain's woes.
Yeah.
And
they're a huge global bank.
Well, not only that, but they're the big one out of Asia that ends up being the conduit for which an awful lot of Chinese money flows. So all that said, it's way underperforming. That's more of a symptom of that. But that all said, we are seeing dramatic underperformance of the UK financials for obvious reasons. The fear that everybody has said, we'll move all those banks, we'll move all the insurers. Well, that's typical nonsense that comes out before we end up having a vote. But the bottom line of it is they are deeply discounted. For those that have a little bit more favorable outlook, if there's one area that will get a bounce on any sort of retain or remain, it will definitely be the bank or the financials in the UK market that'll get the immediate response from foreign investors.
And even apart from Brexit, when we talk about life cos and we talk about banks, low global yields, it makes it for a tough business, and that means that they're among all kinds of investors. Everyone's hunting for yield and trying to find it in new places. But we talked a bit about this earlier. Obviously, you have to worry about the risk that you're taking. If there's a high yield on being paid out, maybe it's being paid out high for a reason.
Well, that is it. And what we're finding is, as I said earlier, we're finding the investment in all kinds of instruments which don't necessarily make me happy because they're not exactly clear on their risk level. But the bigger issue, of course, is people relate the fact that the UK market, in particular London, will have a big dramatic impact to the negative side on the real estate market because a great deal of that foreign, either Saudi, Russian, or Iranian money would leave London. Well, money likes to have a secure home. That's part of it. But that said, they've got way too much money for an immediate relief. You will see some of that. But like we saw in so many crises before, you get the immediate sells and then the shocker comes back and then prices remain there at a high level. So that's the low interest environment having a huge impact. So to think that it's going to have this big decline, I think is a little too much.
What happens if, I think you call them precarious investments, companies in more precarious positions? That seems to be money flowing in that direction. It could be bad news if things start to unravel. Well,
this is the part that I find really hard to accept. The fact is that you've been pushed out of the safe, relatively low risk environment. Thank you for the crowding out by the government. And that has pushed you into higher risk to get a return. That's really unwise, unsafe. And for a lot of people that are fairly ignorant on what is going on in the financial community, should be something that they should be asking people about exactly where those investments are. I'm hearing horror stories about real estate prices that are getting absolutely ridiculous cap rates that make no sense if you're in fact in that game. But that said, it's like why people are still chasing negative rates when you're told you're going to get negative return. And a lot of it has to do with crazy regulation that is being imposed by governments. And in the case in Europe, which is the big crux of the Brexit, is that the EU is making these demands on the banks, and therefore what people find it really tough is suddenly non-elected officials are making big decisions for companies that are in private business. That's proven to be unwise as well.
All right. One of the things that we're seeing is this flight to gold.
Yeah.
Gold just keeps getting a bid, it keeps getting a bid. It pulls back from here today, but it's just been...
This has been the fallout, and it's not often that you hear me bullish, but I have been bullish this year on gold. And the reason has been directed towards this negative rates. At least you've got some sort of assuredness that you're going to get an ounce of gold. At least you're going to get an ounce of gold back. In periods where there's this type of uncertainty when it comes to highly volatile currencies and unknown risk, this is the natural drag that happens, that you get money moving into gold. That said, we've got both the gold miners and the gold price itself up to some pretty lofty levels. It looks to me like after a brief pause, and I still will stick with this, that a minimum $1,600 on the gold price is likely this year, because now we have no reason to believe that we're going to get any change in that negative rate policy. This is, to me, it's sad because we're getting it reinsured. Even some of the Fed governors who used to be so hawkish are now turning very dovish, and that says that it's unlikely that we're going to get the rate rises. that's never a good formula. When people are absolutely set in one direction, which is happening right now, that there'll never be another rate rise in our history, well, that's why you're getting people taking out insurance. And so smart money has been moving into gold.
A lot of fascinating moving parts. Thanks for walking them through.
Okay, thank you.
Pleasure.
Thank you.
Of course, David Prince, founder and president of Harbinger Capital Markets.
Okay, folks, stay with us after the break. Francis Cordolino, who is Principal Market Analysis at CMHC, and he joins our affiliate BNN to discuss what's going on in Montreal's housing market. And we conclude today's show with a fun interview with Christina Partsenevelos, who tells us about a new Harley-Davidson cafe in Toronto, and it's the first branded Harley-Davidson cafe ever. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
As you heard with our top line, we're focusing again on housing. It is a major issue for the economy across the country. But while we talk a lot about housing markets like Vancouver and Toronto, it's also important to compare that to what's happening in other big markets like Montreal. For the state of that housing market, Francis Cordolino joins us now from Montreal, Principal Market Analysis in the region for CMHC. Francis, thanks so much for joining us. First, we obviously have the Prime Minister, who was a guest on this show just a week ago, talking about how the housing situation is a drag on the overall economy, now talking about this being a crisis. What's your reaction to his latest comments?
I would say that, like every market, it's really regional. So for Montreal, it's quite different from what's happening in Toronto and Vancouver. So we have to look what's happening in every market. So for Montreal, for instance, it's quite different if you look at the starts, the resale market, the price. Maybe that the Prime Minister was talking about he wanted to do a deep dive into those markets. So for Montreal, the elements, the fundamentals are a bit different.
So tell us about the fundamentals in Montreal. For example, it's easy to understand when talked about in terms of price or price increases. On that front, what are you seeing in Montreal right now?
So right now, the average price on the resale market is increasing like as 2-3% per year. It was like that since maybe 2 or 3 years now. So small increases. And the last decade, the average price was increasing at a pace at like 5, 6, 7%. So it was much higher. And what we see for the moment, it's probably a moderate signs of overvaluation in the Montreal market because of those huge price increase in the past. But right now, prices are not increasing as much, and fundamentals like employment and growth in first-time home buyers or mortgage rates are still low. So there's overvaluation, signs of overvaluation in the market, but fundamentals are increasing as well at the moment.
So if you hear all the commentary coming now from the federal government, which is collecting data, it's collecting information to try to make a determination as to whether or not more significant action has to be taken to cool down the hottest housing markets in this country, and yet we talk about it as a federal government initiative. If there was some kind of action, how would you feel about that, given the fact that the pace of growth in a market like Montreal has been very different than the pace of growth in, say, a Vancouver?
Good question. I think that the CMHC is right now talking with the Minister of Finance and all other departments of the federal government to see if should we done something, and if the answer is yes, what should be done. But at the moment, I think it would be maybe too early to speak about any action and the effect that could have on the market.
In your market, though, one trend I believe we've seen is on the renting side. Talk a little bit about some of the dynamics when it comes to sort of what decisions people who are in need of homes or condos or apartments are doing right now.
So for the last few years, there was a lot of condo being built in Montreal. So, but now the demand is a bit weaker. So with the condo market, the new home condo market running out of steam, builders were looking for their opportunities, and they went to the rental market apartments. And the thing is, even if the vacancy rate overall in the Montreal region is increasing, for more recent buildings, the vacancy rate is quite low. So there seems to be demand for modern units. So builders are in the rental segment right now, And when you talk to builders, they believe that baby boomers in the next years, they will downsize, sell their homes, and they will go probably in the rental market because you can get in of that market and get out easily. You don't have to resold your condo. You don't have to take care of renovation for the buildings, stuff like that. So they believe that's where the market is heading right now. And also for the Quebec region, especially with the aging population, there's more and more retirement homes being built because old elderly people will need a place to live in the near future.
When people talk about the factors that drive pricing, you talk, for example, even about jobs. I mean, it's everything from mortgage rates to supply to whether or not it's a region where you're seeing growth in population or growth in jobs. But certainly a lot of the attention has been on the hard to measure foreign ownership factor here. Do you have any anecdotal evidence you can share on that kind of trend in a market like Montreal? I mean, we hear a lot about it with Vancouver, although more of it anecdotal than substantial. We certainly hear about it here in Toronto as well. What can you tell us about foreign ownership trends in a market like Montreal?
Actually, we did a roundtable with some builders and realtors a couple of weeks ago, and we did some research that we presented at conference and events like that. And in Quebec, we have access to land registry data, assessment roll data, and also we do our own survey with foreign ownership. And all those database or survey are going in the same direction for Montreal, so that the proportion of foreign investor is small. And when they are foreign investor, it's in the condo market and in downtown Montreal. So that's the main result, all going in the same direction.
And if the trend is going in that direction, and say there was some kind of decision to have, say, some kind of tax on foreign ownership, how do you think that might affect the Montreal market?
For Montreal, because the number of foreign investors seems to be so small, so if you look at the overall housing stock in Montreal, I would believe that the impact would be marginal because there's so few in a region like Montreal.
Okay, Francis. Well, thanks for sharing your insight with us. Francis Cordolino of the CMHC, who specializes in what's happening in the Montreal market. Obviously, the housing situation tricky because we're talking about local issues that come together to create a big question for the overall Canadian economy.
The coffee culture might not be the first thing that comes to mind when you think of iconic motorcycle maker Harley Davidson, but a new Harley branded cafe in Toronto looks to change that, and Christina Pretz-Novas has more.
I am definitely taking it up a notch from my CCM bicycle that's outside work right now. This is a Lowrider-esque Harley Davidson bike. I'm at the 1903 Harley Davidson Cafe, named after the year it was founded. This is a first for Harley Davidson. Half showroom, half coffee bar, featuring Fahrenheit coffee. This is a local institution in Toronto. You've got all your brews here, as well as two lovely gentlemen, and it's just some of the example that you can get here, because you also have some of the latest models for Harley Davidson, including the Street 500. And this is supposed to break the mold of what a lot of people think Harley Davidson is about. You think maybe an older man wearing leather, maybe has some gang emblem on his back. This isn't the case for the Street 500. This is an entry-level bike geared toward the younger demographic. It actually is priced a little bit below $8,000 Canadian, so definitely a little bit more affordable compared to the more expensive models. And as you can see, this space is huge. It's absolutely huge. It is open until September. If there's enough demand, they will keep it running. There's free Wi-Fi here. And the goal is to get those newcomers, the younger demographic, to come in here and learn more about Harley Davidson bikes. And you can see over here, we've got some guests and clients, because it literally just opened today on Ossington, just north of Queen West. In the back of the room is an exciting part. It's called The Shed, and that's where you have a specialist, a Harley specialist, that is there to work with you. If you're a newbie, there's workshops that are being hosted called wrenching workshops. There's also a bike where you can sit on it and rev the engine should you want to hear that Harley experience. And Harley actually has a presence, a very strong presence in Canada. They've been here for 99 years. They're going to be hitting their 100-year mark very, very soon. They've seen 8 months of growth with 16% year-over-year increases, so definitely growing. We used to be the second largest market for Harley. Asia is taking over. The United States is leading the market, but nonetheless, this is an example of how Harley is trying to get involved with the urban community in Toronto. If it goes well, maybe they'll open some more across the country. I'm going to throw it back to the studio.
What an interesting way to sell and market Harleys.
Okay, folks, that's it for Money Talk. Thank you so much for joining us. Stay cool, have a good week, and we will be back next Sunday at 2 p.m. I'm John Budden, and you are listening to 580